When a modern corporation generates billions of dollars in surplus cash, that money becomes a liability. Sitting idle in corporate accounts, it earns minimal returns, frustrating investors and putting intense pressure on the chief executive to put that capital to work. In response, executives frequently deploy a financial maneuver that increases the price of their company's stock and inflates their own compensation, all without designing a single new product, entering a new market, or growing their actual revenue. For much of the 20th century, this tactic was heavily restricted. Prior to 1982, if a company attempted to purchase its own stock on the open market, it faced intense regulatory scrutiny and the constant threat of being charged with market manipulation by the SEC. That year, the Securities and Exchange Commission adopted a rule change that granted corporations a legal safe harbor. Protected from manipulation charges, executives suddenly had a clear, legal pathway to use company cash to buy their own shares. Historically, when a company had excess cash and lacked profitable investments, it simply mailed a check to investors. These direct payments are known as cash dividends. But dividends come with a dangerous psychological hook. Once a board of directors authorizes a regular dividend, the market expects that payout to continue indefinitely. If a company hits a rough quarter and decides to reduce or pause its dividend, investors interpret it as a sign of financial distress, routinely causing the stock price to plummet. Dividends also trigger immediate, unavoidable tax liabilities for every shareholder who receives them. Repurchasing shares, by contrast, defers those taxes. When a company buys back its stock, the remaining investors see their equity increase in value, and they owe zero capital gains tax until they actually decide to sell. Facing the rigid permanence and tax friction of dividends, boards began searching for a highly flexible alternative. They found a mechanism to return capital to investors during boom years, which they could quietly turn off during a recession without triggering a market panic. The mechanics are straightforward. A company takes its surplus cash, goes to the market, buys a block of its own outstanding shares, and permanently retires them. To see exactly how this manipulates a company's financial profile, look at this diagram. This circle represents a company's total earnings, divided equally into 100 slices, with each slice representing a single outstanding share. This ratio gives us the crucial metric known as earnings per share. Notice what happens if we remove 10 of those slices through a stock buyback. The remaining 90 slices expand to fill the exact same space. The company hasn't actually earned a single dollar more in total revenue, but the earnings per share for the remaining investors has mathematically increased. The largest corporations in the world deploy this math continuously. Apple, for example, generates massive cash reserves and regularly dedicates tens of billions of dollars to retiring its own stock, consistently reducing its overall share count year after year. Wall Street evaluates companies heavily based on their earnings per share. By systematically shrinking the denominator of that equation, executives can engineer an upward trend in their core financial metrics, creating the appearance of robust growth even if the underlying business is completely stagnant. The standard way companies execute this is through open market repurchases. They hire a broker to slowly buy up shares over many months, adapting to daily price changes. To avoid SEC scrutiny under Rule 10b-18, the company must follow strict volume limits, ensuring they don't buy too much on any single day and artificially pump their own stock price. But the open market method is slow. A billion-dollar authorization might take 2 years to fully complete, leaving the company vulnerable to market shifts in the meantime. Sometimes management does not have 2 years. If an activist investor is attempting a hostile takeover, or if the board believes the stock is severely undervalued and wants to signal extreme confidence to the market, they need a mechanism with immediate impact. In these scenarios, they abandon the open market and deploy an accelerated share repurchase. This flowchart illustrates the aggressive nature of the transaction. A corporation signs a forward contract with an investment bank. That bank borrows millions of shares from institutional holders and delivers them in one massive instantaneous block directly to the company, bypassing the open market completely. The company gets its shares immediately, shrinking its share count overnight. But in exchange for that speed, the company fully prepays the bank and completely surrenders its right to cancel or pause the program if the economy suddenly crashes. By locking their capital into a legally binding contract, executives remove their own flexibility. That deliberate lack of an exit strategy signals absolute certainty to investors that the company is committed to the repurchase. When executives willingly abandon their financial flexibility to lock in an accelerated share repurchase, it begs a clear question. What drives a CEO to commit corporate cash so aggressively, particularly when their stock is trading at record highs? The answer often lies in their own employment contracts. Many corporate boards link a massive percentage of executive bonuses and stock awards directly to hitting specific earnings per share targets. We can see this clearly by looking at Xerox during the previous decade, when leadership faced a strict performance threshold to trigger their incentive plans. The company utilized corporate cash to execute a major buyback, shrinking the outstanding share count exactly enough for then CEO Ursula Burns to hit an earnings per share target of $1.12. Hitting that precise number secured a high bonus and unlocked a massive increase in her long-term incentive awards the following year. When leadership's personal wealth is tied to a metric they can alter using corporate cash, the decision to buy back stock ceases to be a purely objective financial calculation. The incentive structure invites executives to prioritize short-term metric engineering over the long-term capital needs of the business. This behavior has scaled across the entire economy. In 2024, companies in the S&P 500 spent over $940 billion repurchasing shares. Proponents argue that this is simply good corporate hygiene. If a mature company has exhausted its profitable growth opportunities, returning that surplus cash to shareholders is far better than wasting it on bloated, low-return vanity projects. Critics look at that same trillion-dollar figure and see a vast diversion of resources. They argue that capital spend shrinking share counts is actively withheld from research, vital infrastructure development, and employee compensation. It comes down to a distinction between building real economic capacity and manufacturing a financial mirage. A successful product line generates returns for decades. An inflated earnings ratio looks excellent only until the next quarter's report. As long as the market rewards immediate gains and compensation packages remain tied to easily manipulated metrics, corporate boards will continue to choose the buyback. The question is whether they are securing their company's future or simply using their own cash to buy themselves a little more time.